How to improve your credit score, proven strategies for 2026. Before we dive in, advertisements may pop up on this video. Please do me a favor. Don't click off of the advertisements. Please allow them to play through as a thank you to me for sharing with you this honest, valuable information for free. Now let's continue. As we move into 2026, the lending landscape has undergone a fundamental shift. We've moved away from the era of easy capital into a period defined by rigorous creditworthiness assessments and precision-based underwriting. For the prime and near-prime borrower, your credit score is no longer just a number. It is your most valuable financial asset. It determines your access to the current interest rate environment and dictates your total cost of borrowing over the next decade. In today's market, a 20-point swing in your score doesn't just change your approval odds. It can represent a difference of tens of thousands of dollars in cumulative interest charges on a mortgage or structured personal loan. Today, we aren't talking about quick fixes. We are analyzing the structural frameworks that major banks and regulated fintech lenders use to evaluate risk, and how you can strategically align your profile with those standards to optimize your long-term financial trajectory. This briefing is for educational purposes and is designed to help you understand the mechanics of credit scoring and lender behavior. To improve your score in 2026, you first have to understand how the goalposts have moved. Reputable institutions, your Tier 1 banks and credit unions, have shifted toward more sophisticated, trended data. Historically, a credit score was a snapshot in time. Today, lenders look at the velocity of your financial health. They are analyzing your borrower risk profile through the lens of stability. When you look at your report, you shouldn't just see a balance, you should see a utilization trend. Lenders in the current high-rate environment are increasingly sensitive to debt-to-income, DTI considerations. Even if your score is high, a rising DTI can signal to a lender that your capacity is shrinking. To optimize your profile, the strategy is no longer just paying on time. That is the baseline. The strategy is managing the ratio of your revolving credit against your total liquidity. By maintaining a revolving utilization under 10%, rather than the commonly cited 30%, you signal to the automated underwriting systems that you are not credit hungry. In a tighter capital market, the least hungry borrowers are the ones who receive the most competitive fixed versus variable rate offers. Why does your score matter more right now? Because the gap between prime and subprime pricing has widened. When you evaluate a borrower's total cost of borrowing, you have to look at the APR versus the total interest paid. A borrower with a 780 score might be offered a 5.5% fixed rate on a significant loan, while a 680 borrower might see 9% or higher. On a $50,000 professional or home improvement loan, that spread results in a massive divergence in your net worth over 5 years. To improve your standing, you must focus on account seasoning. One of the most common mistakes prime borrowers make is closing legacy accounts that they no longer use. In the 2026 credit model, the age of oldest account and average age of accounts carry significant weight in risk modeling. These metrics serve as a proxy for financial maturity. Before you decide to consolidate or close an older line of credit, calculate the impact on your average account age. Often, the long-term financial impact of a slightly lower score, caused by a shortened credit history, outweighs the perceived simplicity of having fewer accounts. We've seen a rise in regulated fintech lenders who use cash flow underwriting alongside traditional FICO or Vantage score models. While traditional banks focus on your past, These institutions look at your real-time financial stability. This is where responsible borrowing decisions become visible. If you are looking to bridge a gap or fund a major purchase, these lenders look for positive residuals, the money left over after all obligations are met. To improve your attractiveness to these high-end lenders, you should focus on consistency of income deposits, maintaining a stable, predictable inflow, reduction of non-essential outflows, showing a high margin of safety. By demonstrating that you understand your own risk profile, you move from being a data point to a preferred client. This distinction is what allows you to negotiate for lower origination fees or better terms that aren't available to the general public. Now, there is a counterintuitive mistake that even very high-income, credit-conscious individuals make. It's something I call the silent utilization trap. Most people think that if they pay their balance in full every month, their utilization is 0%. This is a fundamental misunderstanding of how data is reported to the bureaus. If you spend $10,000 on a card with a $20,000 limit, and the bank reports your balance before your autopay kicks in, the credit bureau sees 50% utilization. To the algorithm, you look like a high-risk borrower who is potentially over-leveraged, even if you have the cash in the bank to pay it off instantly. This reporting lag can cause your score to fluctuate by 30 to 50 points month to month, potentially hitting you right when you apply for a major mortgage or an auto loan. In a moment, I'm going to show you the statement date versus due date framework that savvy borrowers use to ensure their reported data always reflects their true creditworthiness. This one shift can be the difference between a standard and a preferred rate offer. To avoid the trap we just discussed, you need to manage your statement closing date, not just your due date. If you want to maximize your score for a major upcoming credit application, you should aim to have your balance at nearly zero on the statement closing date. This ensures that when the lender's snapshot is sent to the bureaus, it reflects maximum available capacity. This is a hallmark of a credit-conscious borrower. Furthermore, let's discuss the long-term financial impact of credit inquiries. In 2026, lenders are more cautious about rate shopping behavior outside of the standard windows allowed for mortgages or auto loans. Each hard inquiry is a signal of intent. If you are evaluating different borrowing options, always look for lenders that offer a soft credit pull for pre-qualification. This allows you to perform your due diligence without impacting your score. Only commit to the hard inquiry when you have compared the APR, the fee structure, and the terms across multiple regulated institutions and have identified the most cost-effective path. Finally, we must discuss creditworthiness assessment from the perspective of the lender's margin of safety. In a volatile economy, lenders favor borrowers who show unused capacity. If you have a $50,000 credit limit and you use $5,000, you have a $45,000 margin of safety. If you request a limit increase without increasing your spending, you are technically improving your risk profile in the eyes of the scoring models. However, this must be balanced with debt-to-income considerations. A responsible borrower knows that credit is a tool for liquidity, not a substitute for income. Improving your score is not about gaining the ability to spend more. It is about gaining the ability to pay less for the money you choose to use. Improving your credit score in 2026 is an exercise in intentionality. It requires moving beyond the pay-your-bills mentality and into a risk management mindset. By understanding the interest rate environment, managing your reported utilization, and maintaining a long-term borrower risk profile, you position yourself as a low-risk, high-value client for the world's leading financial institutions. This, in turn, ensures you always have access to the lowest cost of capital. Audit your statement dates. Identify when your banks report to the bureaus. Evaluate your DTI. Before your next major application, look at your debt-to-income ratio through the lens of a conservative underwriter. Perform due diligence. Always compare the total cost of borrowing, not just the monthly payment. If you value this high-level, data-driven approach to personal finance, please consider subscribing. We focus on the structural side of wealth, helping you make informed, responsible decisions that protect your financial future. Hit the like button if you found this framework helpful, and leave a comment below. What is one question you have about how lenders are viewing risk this year? I do my best to engage with the community and provide clarity where I can. Disclaimer: I am not a financial advisor. This video is for educational and informational purposes only and does not constitute financial, legal, or investment advice. Credit scores and lending terms vary based on individual circumstances and lender policies. Always consult with a qualified professional before making significant financial decisions.